Hello, accounting scholars. Hey, we're at the last section of Chapter 9, Section 4. We had a lot of complicated terminology in the last section talking about overhead rates and how overhead rates are computed. We're going to look at an example here, and I think that's going to pretty much clear this all up because accountants like to overcomplicate things, and quite frankly, it's pretty much an arithmetical operation to do all this. So let's bring back IKEA into the picture. And so we talked about these cost pools, and they have cost pools that vary with the number of machine hours that are used in production. And they have another cost pool that varies with the number of production runs used during the period. So they estimate their machine-related costs are approximately $500,000 or $500,000 for the period, and they believe that 50,000 machine hours will be used. In addition to that, they also estimate their production run costs at approximately $400,000 for the period, and they're expecting approximately $400 or 400 expected production runs. So the question is, how do we determine these overhead rates? And the math is relatively straightforward, as I mentioned to you. If you take the example for machine overhead, as stated in the problem, they had approximately $500,000 of machine-related costs. So you would take that $500,000, and they estimated that there would be approximately 50,000 machine hours in the period. So your overhead rate or your cost driver is approximately $10 per machine hours. On the production side, the production run costs, overhead rates, they said they had approximately $400,000 for the period. They had approximately 400 production runs, where they've started the production line and ran a bunch of raw materials through it to make some finished goods products, and therefore the overhead rate or cost driver is approximately $1,000 per production run. So if we continue along with this particular example, so let's say you get this the following manufacturing activity, and they want you to apply the overhead costs to the work in process inventory. So they pretty much give you the stats associated with machine hours from week 1 through week 4. 8,000 week 1, 8,800 week 4. And then the production runs used are 125 in week 1, and it varies between week 2, week 3, and at week 4 they're up to 130. So pretty busy time in the factory in week 4. So essentially, then to do the math to compute the overhead. Machine overhead and production run overhead. In week 1, you would you'd basically take those 8,000 hours that we talked about, and you multiply that by $10, and you pretty much come up with your machine overhead. You do similar math. You take the 125 in week 1. And you multiply it by $1,000, and you get the $125,000. So again, it sounds much more complicated than it necessarily is in terms of actual computation. But the important point here that you need to remember is in that work in process inventory, you have to account for those overhead costs, those indirect costs that aren't necessarily associated with a particular product. Again, examples of that would be utility costs, or the salary of the vice president of manufacturing, or the director of manufacturing. Okay, so there are other types of variances, and now this gets really into the cost accounting area, which is to some extent beyond the scope of what we need to cover in college accounting. But you do need to know about this, in that standards are set for particular unit costs. And if you take direct labor, for instance, when you're estimating the cost of a product, you estimate that a certain amount of labor should be, unit labor should be associated with each product. Well, the reality of it is, like any plan, you're going to have variances from the plan. And these are called direct labor price variances, direct labor usage variances, and you also would have a similar kind of situation in direct material variances. Again, depending upon how good your purchasing department is, in a lot of cases they may be able to get materials at a lower cost than you estimated. And these would result in direct material price variances, or direct material usage variances, or actual direct material inventory variances. So, here again, what you're trying to do from an accounting standpoint is basically account for the reality of what actually occurs. You might assume, for instance, that labor is going to cost you, 50 cents per unit. If for some reason you hired a new employee and they needed to be trained and they weren't as productive as a normal employee, it's going to take that person longer. So you're going to have a labor variance. And again, the same thing with material variances. Depending upon the capabilities of your purchasing department, you could have price variances, you could have usage variances, and actual inventory variances. So we're going to end the chapter here, guys. Good job. Make sure, again, that you've got good detailed notes, and we will see you tomorrow in class. Have a great night.